Recording. So, hello and welcome to another of our BTRM free webinars. My name's Ed Dennison and I'm the course coordinator here at the Certificate of Bank Treasury Risk Management, and I'm delighted to introduce our speaker today, Professor Jessica James. She's had a long and illustrious career which now sees her a senior quantitative researcher at Commerzbank, along with being a visiting professor at UCL and the University of London Business School, but more importantly, we like to think, we're proud to count her as a member of the faculty at the BTRM. And today she's here to talk to you about long-term bonds in the current climate, and since that's something I know nothing about, it's high time I let her take over. So, over to you, Jessica.
Thank you very much. So I'm delighted to present this to you. I think it's actually the first time I've presented it in its entirety, so quite exciting, really. It all started when I was looking at long-dated issuance and realizing that there'd been quite a plethora of it in the last few years. What is it? Why do people do it? Why do people buy it? Well, issuing long-dated debt isn't new. Currently, it's being issued because only in the last few years, today, of course, it's somewhat different, but only in the last few years has it been possible to have a bond with a attractive coupon if it's very, very long dated, or perhaps if it's a very poor credit, but that's not a bond that everybody wants to buy. But if one can stretch out its tenor to 50 or even 100 years, then yields at those tenors are still quite attractive and were still fairly positive. And this was in a world where German 10-year debt was attracting a negative yield. So various investors, such as pension funds, insurance companies, needed high credit debt with positive coupons, were quite desperate for it, in fact. And so these two facts, the fact that there were issuers who could issue with a good credit rating and a decent coupon, and investors who were very desperate for this kind of instrument, drove the issuance of this long-dated debt. Now, when I said it isn't new, though, I did mean that. In the, I think, late 70s or early 80s, the British government finally redeemed the last of the debt from the Napoleonic War, the consols. Those were so named because they consolidated other bits of previous government debt. And they were paying, I think, something like 2.5% or 3% all of that time. So the story of long-dated debts being honoured actually does have some weight to it. Another thing that I learned, which may interest you as part of my work being a pension trustee, I believe there is still, or there was still very recently when I last checked, a lady in the United States still receiving an American Civil War widow's pension. And you start to try and do the numbers in your head and it seems a little incredible. So the American Civil War veterans had a generous pension, which transferred in its entirety to their spouse when they died. So there was a bit of a trend for elderly pension receiving veterans to marry young wives. And there were some circumstances, I believe, where this pension could pass on to a child. And I believe that the child who is still in receipt of the Civil War pension was somewhat disabled, and therefore the pension passed to her. So long-term debts can indeed be honoured. There's quite a recent rush, however, of these very long-dated bonds. We've got the states of Austria issuing a century bond. We've got exciting corporations like Coca-Cola and Disney. I think Oxford University might have even issued a 100-year bond. So these things aren't as unusual as you might think. So let's have a look at how they work, because initially a 100-year bond from the European government, oh, forgive me, Somebody's just trying to FaceTime me. So there is some history that says that these debts tend to be honoured, but at the moment there seems to be a lot of them. So you'd think that a 100-year bond from a European government, like a European state body like the States of Austria, would be a stable, safe, long-term object. But just let's think about the mathematics of bonds. Let us say that I issue a 5-year bond at par. The coupon of the bond is 2%. Let us say that 5-year interest rates at the time of issue are 2%. The bond is worth 100%. And if interest rates change, so if they go down to 1%, then what's the value of that bond composed of? Well, it's composed of the discounted value of all its cash flows. So it has some coupons which are now below market rate. Fine. So the difference between those coupons and current rates mean that your bond is valued at less than 100%. But the bulk of the value of that bond is the discounted value of its final cash flow, which is the principal, and that may reduce a little if interest rates change, but not very much. So sorry, of course, if the bond was issued at 2% and rates drop, then it's worth more, of course, because it's paying above the odds. So when you issue a long-dated bond, say at 2%, say long-dated rates are then 2%, and it's a 100-year bond. So the value of that bond is the discounted value of 100 years of coupons plus the principal, but the principal is so heavily discounted because it's a century ahead that it's worth almost nothing. So any slight difference between current rates and this stream of coupons will become enormously magnified because of the huge tenor. So if interest rates drop to 1% and you're getting 2%, then the value of the bond will balloon. But if interest rates rise to 3%, then the bond will be worth a fraction of its previous value. So although one likes to think of a 100-year bond as being terribly stable, its value can be incredibly variable and has been, as we'll see. So normally when investors think of and issuers think of how to understand the variation of bond price with interest rates, then you think of two things: duration and convexity. By the way, if I say yield, I mean the current market yield, which is the same as the current market interest rate environment, just in case there's any confusion over that. So duration is the first derivative of the bond price with respect to yields, and that means it's a linear approximation of price sensitivity with regards to yield changes. So you draw a graph with price on the y-axis and yield on the other, and it would be a straight line. Note, of course, that it's a straight line with a negative slope, because as yields go up, bond prices go down. Then you actually realize that there's a curve. It's not a straight line, and convexity is the word that describes this curve. It models a degree of nonlinearity, and it's always an advantageous degree of nonlinearity for the bond owner, because as yields go up, the price drops less than the linear approximation. As yields go down, the price rises more. So convexity is always taken to be a good thing. So that kind of translates in everyone's mind as nonlinearity in the bond price yield sensitivity is good, but let's just see, because it isn't always. And for these super long dated bonds, convexity isn't enough. Let's see why it isn't enough. So let's go back to basics, and here is the present value of a bond. The PV depends upon the yield and the coupon, and the tenor, which is the number of years n. The bond return is change in PV due to a yield change divided by PV. Now, often when one is talking about bond price sensitivities, convexity, duration, etc., people confuse bond value and bond return. For normal length of bonds where the actual price itself changes relatively little, it doesn't matter and the maths just about works out. But once you get to these long dated tenors where price changes are very significant, then defining it carefully as the return is critical. And this is also where DV01 comes in. A change in yield of 1 basis point applied to the price of the bond gives you the DV01, the value change for a 1 basis point yield change. So duration is usually defined as modified duration, which is the first derivative of price with respect of return with respect to yield, but there's a negative sign and a factor of 100 applied to it. And this is quite important to remember. With that negative sign and the factor of 100 for a low coupon bond, this will look kind of similar to the tenor of the bond. So it's a nice familiar way of approximating bond price variation. So duration isn't the whole story, however. Hang on one moment, just to... So here is convexity. Now, let me just say that convexity has many different definitions, and it can be itself a very large number. So when you're using convexity, it's always quite useful to actually take it right back to its underlying definition with looking at the derivative of value with respect to yield change. So a bond of low duration but high convexity will become more sensitive to yield changes as those changes get larger, for example, than the linear duration would imply, particularly for when yield changes are negative and price increases. So that end of the price of the bond return curve is far steeper, so it will increase in value as yield drops far more quickly than it will decrease in value as yield rises. So those two terms that I labelled 3 and 4 in the presentation, they're actually coming from the first two terms of a Taylor expansion. Now let's have a look at a 30-year bond and a 100-year bond. Here's the return of the bond, which, as we recall, is delta PV over PV, and look how it changes with yield change. So this is a starting yield of 1%, and then the x-axis yield value is the final yield. So at 2, your delta yield is plus 1%, at 3 it's plus 2%, etc. So the 30-year bond, you might even say, has a somewhat linear response. No way does the 100-year bond have a linear response. And also, do look at the y-axis. You've got not quite 1% for the 30-year bond in the positive y-axis, and you've got 3% for the 100-year bond. So if you plot them together, your 30-year bond will be right at the bottom of that graph. So the 100-year bond is immediately wildly different in its response to yield changes. So now let's take a look at that same equation, which is the PV of the bond. But if you go back to your second year A level, in my day, I think it might be first year maths in the modern world, but you can simply rewrite that sum as equation 5 below. I won't go into it because you can easily look up how to do it, but rest assured this is an exact expression, it's not an approximation. But the beautiful thing about equation 5 is that you can do so many more things to it. We've defined v, this variable, as 1 over 1 plus y, which turns out to be very useful. So the great thing with equation 5 is that it's easier to differentiate. So what we would like to do now is to look at the expansion of bond return under yield changes, and look at the Taylor expansion, and let's look at the first two terms, which we know are the origins of duration and convexity, and let's see if we can get out the third and the fourth. Now, you will find in various different papers that, and some books perhaps, that this first equation, the dp v by dy, this has been written out a few times, not always in this form, but I think Pricing and Hedging Swaps by Mirren and Swanell gives this expression, although I think there's actually a mistake in it. And I have once seen the second one written out. I think it was a Jess Chua paper, but I'm not quite sure it was correct. I haven't actually seen published the third and the fourth, and it took quite a lot of algebra and a lot of help from Mathematica Online to get them out, but I'm quite sure they're right, and they've been pretty rigorously checked. And although they look complicated, once you actually look at the different parts of them, they are all quite they all have nice patterns to them. For the first term, you can see you always have v to n plus 1 plus 2 plus 3 plus 4, etc. So if you do go through them, one starts to be able to almost, by observation, get out something like the further terms. So these have, I think, a nice analogy, which is an analogy with the physics of roller coasters. So you've got velocity and acceleration with a roller coaster, which is fine, but the further derivatives, which I think are usually called jerk and jolt, so the further to the third and fourth derivative of distance with respect to time, are almost intolerable for people to physically experience. So it's that kind of horrible snap as something starts or stops very suddenly. People can cope with smooth acceleration and even rather enjoy it, especially if, like me, you've just discovered that seasick tablets give you back your joy of roller coasters. But the third and fourth derivatives of distance with respect to time are very unpleasant. So roller coasters are designed to minimize the third and fourth derivatives, the jerk and jolt. Now, that's why if you look at a roller coaster loop, it's always teardrop shaped. The top is rounded, but then the bottom, if you like, if you could see through it, the bottom and it comes to a point, and that way it helps to minimize jerk and jolt. So there's a little bit of an analogy with the roller coaster world of the recent markets, which can be amusing. Now, if you want to code up those derivatives in a spreadsheet, and you absolutely can, although it's easier to write a function, then you must put in a limiting case for when the yield approaches 0, because otherwise the spreadsheet will just blow up. And this is the limiting case. And again, that has been checked with Mathematica Online. I'm quite sure it's right. So now we can have a look at the return sensitivity to yield with an understanding of where all its different elements are coming from. So again, we've got our friend the 30-year bond and the 100-year bond. And the pale grey, which I hope you can see, is a linear approximation, only the duration. Then you can see the yellow, the dark yellow is the convexity. And for the 30-year bond, it makes only just visible difference. For the 100-year bond, it makes a huge difference. So you can see if yield goes from 1% to minus 1%, then the duration gives you less than half the correct return increase. Convexity gets you to 3/4, but you need the other two terms to get to a good approximation. Now, if you look at the case of yield increases from 1 to 3, for example, the convexity is so wrong that it's actually giving you an increasing return. As you can see, it's curving the wrong way, and the third and fourth terms are quite essential to come to a proper approximation of the true return. And then these are just the residuals, so it's the same data, but it gives you more of a picture of how the successive approximations work. And again, it's worth just looking at the y-axis, which is 0.2% for the 30-year bond, and it's 2% for the 100-year bond. So in practical terms, the higher terms are, in practical terms, I should say, the higher terms are essential to actually give a good approximation. With a yield decrease, i.e. a return increase, the different terms simply converge on the right value, but you can see for a yield increase, i.e. a return decrease, they alternate in sign. So duration goes up, convexity goes down, the third goes up, the fourth goes down. And we'll look into that a little bit more later. In fact, we'll look into it a bit more here. So this is as if you'd just taken the end points of those two graphs. So it's for a delta yield of -2 and +2. And you see the gold bars for both of the bonds converge on the present value. So that's for a yield decrease, i.e. a value increase, a return increase. But then for the yield increase, i.e. a return decrease, the black bars alternate in sign, which doesn't matter so much for the 30-year bond, but it matters tremendously for the 100-year bond because the value change is smaller, so the residuals matter much more. So what can we say about these results? Well, I don't think that you're ever going to be able to intuitively think about the third and the fourth terms in the same way as duration and convexity give a bond purchaser or a bond issuer a kind of good feel for how the bond value changes. But I think what you can say is you can use these results to show you where you have to go beyond duration and convexity to understand what's going on. And as a rule of thumb, for a 100-year bond, changes in yield of greater than 1% will be poorly approximated without the third and the fourth terms. In terms of tenor, 50 years and more will be the point at which you need to start to think about terms beyond convexity. So that's actually quite a useful little rule of thumb to recall. So this is another way, I suppose, of looking at the same data. We've now got yield change of -1, +1 and +2. So for -1, you see this smooth conversion. The duration isn't enough, nor is the convexity, but with the third, even the third term is not bad. For +1, again, the third term comes pretty close, but for +2, you're still way out with the third term and you need the fourth term. And then suddenly you start to converge to the appropriate PV change. So now we've got a good way of thinking about when the higher terms need to come in, i.e. when we're getting onto the roller coaster. Let's see if we've really been on a roller coaster ride with the bonds since their issue. And so these are two bonds, the NRW March 2119, which was issued in 2019 from the States of Austria, and then a French, then later there's also a French government bond of 50-year tenor. And if you look at the price, You can see that at the time of its issue, it was approximately 100. Fine. It doubled in value in a year as yields fell. And it then lost it all as yields rose. And in fact, if you look at it today, there's been further crazy activity and it's worth even less. So this bond has been doing exactly the kind of thing that needs to have these third and fourth terms applied to it. And if we go to the next page, you can see those were the actual changes and the actual contributions from the different terms to the values of the bond that we've just looked at, and also a 50-year French government bond, which was issued at a similar time. So you can see that the French government bond is not too bad if you use duration and convexity, but the third and fourth term bring it into line to match its actual return very well. For the NRW bond, so duration wildly overestimates, convexity wildly underestimates. Finally, with the third and fourth terms, you get a reasonable approximation. And this was the end date of these moves was April of this year. In fact, as I said, it has been more volatile since then. And then this is quite a nice way of looking at it over time. So this is the same bond. This is the NRW, the States of Austria bond. I've just covered a shorter period in the second graph, so you can see that it's actually even visible on the graph when the fourth term starts to contribute, and the third term is very significant indeed. And here's the French bond. The fourth term is less important, but by the end of that move, you are needing the third without a doubt. So we've got this slightly crazy situation with bonds, and can you, as an investor, buy them at a lower risk, i.e. can you buy them and hedge them? Well, for these bonds, the obvious hedging instrument would be a 50-year swap. That's the most liquid instrument with the most similar tenor. And what I've done in these graphs is plot the 50-year swap in the light yellow, the bond yield in the dark blue-green, and then the difference in the orange. And you can see that the yield spread has been really very active. Obviously, the two yields are correlated, but the yield spread has actually been extremely active. And it's obviously the yield spread that's going to determine the value swings. Now, here is over the same time period as those graphs. So from 12th March 2020 and 25th Jan 2021 till April this year. And here is the hedged performance, and I've done a duration weighted hedge. So duration by construction is perfectly hedged. So you see that the duration slot in the hedge performance is 0, and it has to be. So the convexity is what, and the further terms is what remains unhedged. So the true hedge performance as simulated, but simulated pretty accurately, is the dark blue bar. So for the French bond, the convexity gives you a lot of the hedge performance, but you need the third term to come to an accurate value, and it's positive. For the Austrian bond, the hedge performance is positive again, which is very nice. You see that the convexity is overestimating the hedge performance by a factor of 2, and you need both the third and the fourth terms to approximate the true hedge performance, and even then it's not perfect. But this is quite nice because looking at it, you've got a positive performance for both. So if you'd bought that bond and sold a 50-year swap, duration weighted, you'd have had a positive result from that two instrument portfolio. So the hedge is good, but moreover, the hedge difference is positive, which is really good. Look at the Austrian bond. The hedged performance is about 3%. So you've bought these two and you've hedged your value swings to a very good approximation, and you've made 3%. Very nice. So why? How? Because the duration terms are cancelling out by construction, but what about the rest? Well, partly the durations were fairly similar because the coupon on the bond at that time was negative, slightly negative. So that greatly increased the duration of the swap. And so the positive coupon on the bond decreased them, so the durations were somewhat similar. However, the greater convexity, particularly of the 100-year bond, is overwhelming. But the third term is also much larger for the bond. So the third term brings that bond back to being better hedged by the 50-year swap. Whoopee! So the hedge becomes more accurate, assisted by the third term, although that will reduce the positive performance. So what if yields fall? Well, again, it's like waving a magic wand. We have a positive performance. How come? Well, you're getting the long convexity, but this time you saw that the higher terms and duration only improved the price change. That remains true, and the greater value of convexity and third and fourth terms means that the positive performance of the bond relative to the swap keeps going even under a negative yield shift. So the hedge error for the 100-year bond is twice that given by only the convexity, but it's twice that, which is good news. But actually this is like a magic wand, because look, yields go down, your hedged bond makes money. Sorry, yields go up, your hedged bonds make money. Yields go down, your hedged bond makes money. What is this? Is this a magic thing? Well, no, of course it isn't, because we've assumed here completely parallel yield shifts. So we've assumed a complete parallel shift of the yield curve, because we're saying that the 50-year rate moves by 1%, the 100-year rate moves by 1%, and as we know, that doesn't happen. So it's going to be curve rotations, which can give you a fall in value of this hedged performance. And as you see, it can fall in value. Here is the actual performance of your duration weighted hedge. And because there has been some yield curve rotation, then you see that this hedged portfolio has actually slightly lost money, but let's not complain too much. This has been a superb hedge. And for the NRW, you can see that actually due to the larger contributions from the third term and the convexity, then you've actually got a positive performance, a positive hedged performance since launch. So that's really quite good news, even in realistic market conditions of acute volatility swings. You've got a pretty good hedged portfolio. So I think this has been quite a interesting exercise to do. Now, just looking at that, you'll see that this looks a bit negative and that looks a bit positive. This is a pure duration weighted hedge. We might go back and do a kind of in-sample weighting where you allow the hedge the hedge ratios to drift away from the duration weighting. it would be slightly cheating because it's out of sample, but you perhaps might use that going forward, or it might not be what you wish to do because these hedges are very good in any case. And also the outperformance under yield falls is greater than the underperformance when yield rises. So you've actually got everything working in your favor. So conclusions, higher terms are important and even essential for super long bonds. You just can't understand their behavior properly without them. But also rising and falling yield environments are very, very different and need to be considered separately. Surprisingly enough, 50-year swaps have been a reasonable hedge for the 100-year bonds. This was partly due to the fact that they had a higher than normal duration due to their negative yield at the start. This effect would still be there, but not quite so strongly if yields were all positive as they will be in the future, one anticipates. And the risks of this hedged performance come from non-parallel curve shifts or swap spread widening or narrowing. So this was an interesting piece of maths in finance, which although it was only algebra, seems not to have been done before, probably because it wasn't previously needed. But quite useful and interesting, and very happy to answer any questions. So not seeing anything come through.
No, I'm not yet seeing anything in the chat. Obviously, people might be formulating their questions or something.
Absolutely, absolutely.
But otherwise, yeah, thank you very much, Jessica. And obviously, we hope that everybody's enjoyed this free BTRM webinar. And if you're interested in more webinars, interviews, conferences, and more about all things Bank Treasury, then please do pop over to btrm.org, where you can also look in signing up for the BTRM certificate itself, where you'll be taught by our unparalleled range of lecturers, both academic and active professionals. Otherwise, did you have anything else to say, Jessica?
No, that's all. Thank you very much. Very good to have been here today with you all.
Brilliant. Thank you, Jessica. Carry on.
Yeah, this slides would be shared where? In the LinkedIn or as a post or in the website of BTRM?
Yes, we will be getting the slides out to everybody that joined us and that was signed up to join us, along with the recording of this session.
Oh, great. Thank you.
Okay.
Yeah.
Lovely. Okay, well, once again, thank you, Jessica, and thank you, everybody, for joining us, and we hope to see you again soon.
Okay.
Thank you. Have a great day.
Thank you. Bye.
Bye.